Good morning and welcome to Stock Market Today. It's Monday, November 4th, 2019, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Get daily stock ideas for you to consider in your inbox every trading day before the market opens. So I hope everybody had a great weekend. U.S. equities finished higher in Friday's trading with the S&P 500 setting a new record close and capping a fourth straight week of gains. Energy, industrials, and materials led while defensive sectors lagged. Treasuries were weaker with the curve flattening after that big post-FOMC rally. The dollar was weaker versus the euro, but stronger on the yen cross. Gold finished down 20 basis points. WTI crude up 3.7% amid headlines that OPEC was considering extending its output cuts in December. So energy, industrials, materials lead. REITs, utilities, comms, staples underperform. And as we get to the desk this morning, S&P futures are up 50 basis points to start the new week. Asian markets were higher overnight. Japan was closed for a holiday. European equities are seeing strong gains as well. Treasuries are weaker across the curve after rates moved lower last week. The dollar is stronger versus the yen and the euro. Gold is slightly higher. WTI crude is up 80 basis points to start the new week. And as we look at the structure of the S&P 500 here, we can see the index advancing from the breakout level. We had the breakout above the 3,000, call it 3020 area. Slight consolidation in that range, and then a pop higher on Friday on the heels of that non-farm payrolls report. Key support remains at the 200-day moving average near 28.85. Then the August lows near 28.20. Now those are the key support levels. In the near term, support is in the 29.50 to 3,000 zone that we have here. You can see, it's been consolidation. We finally break out. Stands to reason that that zone would act as support to any pullbacks. However, in the near term, RSI remains in bullish ranges and Chaikin money flow is bullish. So the indicators are in line with the advance that we're seeing in prices for the larger equity index. So that's all. It's bullish. There's no two ways about it. New highs are bullish for the equity market. Let's take a look at what we're writing about today. In our note to Chaikin Analytics clients, our market in a minute. Another new high for SPY on the heels of that non-farm payrolls report. Remember, the non-farm payrolls report was expected to be a little bit weak because of the strike, the United Auto Workers strike at GM. Expectations were ratcheted down, and the report came in much better than expectations, even with those striking workers being considered in the count. So a positive report from a macro data point perspective. Small caps break out of their consolidation, and that's interesting. We haven't had a lot of good things to say about small caps. 10-year yield continues to base above support. Commodities strengthen further, which is starting to help the cyclicals a little bit. And futures, as we said, do point to a higher open here today. Taking a look at the power bars now for the major indices. There's your Dow up over 1% on Friday. 4 bulls to 7 bears there. So still skewed bearish for the Dow, but nice pop on Friday. S&P 500 adds 94 basis points. Power bar ratio strengthens 123 to 85. Bulls to bears there. NASDAQ an inline performer. 31 to 19. Bulls to bears. Look at this outperformance on the part of small caps. Up 1.7% on the day yesterday. We're going to take a look at the IWM chart a little bit later in the show. But, for a while, the ratio has been bullish, but the underperformance has been pervasive. Maybe this is the start of a trend change. Either way, a breakout by small caps lends a breath confirmation to the strength we're seeing across the market. Bonds downticked, sending yields higher. Energy, big outperformer with that rally in crude, up 2.28%, but still a weak group fundamentally. 16 bearish or very bearish stocks for only 1 bullish or very bullish stock. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. The major indexes are mixed. Taking a look at our stock of the day now. Stock of the day comes to us from the Aerospace and Defense Group, and that's it's been a leading area of the market up until recently. It's Raytheon. RTN, the ticker symbol there, closed at 216, spot 09, up 1.83% on Friday. And what we have here is a continuation higher from a breakout, but we'll take a look at that a little bit later. RTN has a very bullish rating due to very strong earnings performance, very positive price volume activity, and very positive expert activity. Very bullish rating, strong trend, strong industry group, type of name we want to consider. You can see here, stock was in a big consolidation, breakout, retest, now moving higher, consolidating once again. But what do we have here? We have a very bullish stock strongly outperforming the market. So market and model are in agreement. Chaikin money flow persistently bullish. Stock above the rising long-term trend line, keeping the trend strong. Only real knock that I have here is the overbought nature of the stock coinciding with the overbought nature of the market. A couple different ways to play this one. If you're a breakout trader, you're taking the trade, right? You're taking it as long as it's holding above 210 here, between 200 and 210 for a breakout. You're either in the trade or you're taking the trade. If you want to be a little bit more conservative, stick a little bit more closely to our process, you're waiting for something closer to an oversold condition, all else being equal, before getting involved on the long side of the trade here in Raytheon, right? No, there's no one way to do things, and we acknowledge that. There are different types of traders out there with different types of strategies, and as long as you're sticking to the strategy that works best for you and your time frame while managing risk, I can't argue with that. So I think it makes sense here. If you're a breakout trader, you're taking the trade. If you're following our process, you're waiting for the oversold condition. Either way, Raytheon, type of name you want to consider as a long idea. Let's look at our sector tracker now, moving to the major sectors over the last 5 days. Now, in my note today and a little bit later in this show, we're going to take a look at healthcare because healthcare has been at the top of this list for the past few days. And when we start to see that playing out, we sit up and take notice. We want to see what's going on under the hood. We're going to look at that. Tech near the top of the list. Obviously, we want to see tech at the top of the list. It's the largest weight in the S&P 500. Healthcare, second largest weight. Industrials, right, part of that cyclical rotation that we've been talking about. Financials hanging in there as rates are basing. Materials, a little bit of a cyclical play as well. Comms, discretionary, and staples round out the groups that are higher over the past 5 days. Bottom of the list, your bond proxies are lower. Your defensive areas of the market are underperforming as the market breaks to new highs. That's your utilities and real estate. Continue to watch that there. Remember, we had been bullish on these groups, but now if rates are stabilizing and moving higher, we don't remain dogmatic in our view. We change our tune. Energy, despite the big pop on Friday, still down over the past 5 days, but we'll see, starting to see some positives in the commodities. We'll see if that bleeds through into the energy complex. Now, our industry in focus today, capital market services, has been an underperformer over the past 6 months. No two ways about it, lagging the S&P 500 by over 4%. However, the power bar ratio, which measures future potential, is very strong, 26 bulls to 4 bears. Currently ranked number 5 of 21 subsectors. It's moved up 4 slots over the past week. So some of the names there that you may want to consider, and you really have to be selective here. We'll take a look at why. But Ameriprise, AMP, Raymond James, RJF, and Legg Mason, LM, all with very bullish ratings. But here's the group, right? Group still in a consolidation, not breaking the new highs yet, as a neutral ETF power gauge rating, but a strong trend above the long-term trend line. Underperformer, but what we're seeing here is the intensity of underperformance dampen of late. So that's an encouraging sign. However, the fund is overbought. Money flow is bearish. So if you're looking at the ETF, it's hard for me to get excited about the ETF, right? Still in a consolidation. There are better ETFs that are breaking out, that are outperforming. But this power bar ratio tells us that this improving relative strength is likely to continue. So we want to continue to watch there and maybe even go look at some of these bullish and very bullish stocks when they are oversold. Don't discount capital markets yet. I just think it's hard to get really, really excited about the fund, but dig in, do the extra work, go under the surface. Let's take a look at what's trending now. Yesterday's S&P 500, gainers and losers. Corvo up 20%, part of that strong semiconductors group following earnings. Fortinet, FTNT earnings sent that stock higher 10.5%. Apache hasn't had a lot to be excited about lately, but earnings sent the stock higher by nearly 10%. Newell earnings 8.5% to the good. And Skyworks up 7.95% on the back of that print in Corvo. Remember how we feel about semiconductors. Loser side of the board, ANET Arista Networks guidance takes that stock lower by nearly 25%. Take-Two, TTWO, no real news there, down 2.87%. IDXX earnings send that bearish stock lower by nearly 3%. CL, Colgate-Palmolive, a very bearish stock, down 2.6% following their earnings. And Hershey, HSY, a bearish stock, down in an up tape, 2.6% to the downside on Friday. No real news driving the trading there. Let's take a look at the charts now. I said we were going to take a look at healthcare. We've been talking about healthcare being up near the top of the sector performers list for the past few days. Well, here's XLV. Here's XLV, the Healthcare Select Sector Spider ETF, breaking out of its own consolidation. Similar to the S&P 500, the broader market. Breakout with the market above this resistance line near $94, coinciding with an overbought reading for the RSI. So a momentum confirmation to the price move higher. We like to see that. Yes, I know it's overbought, but when a fund or a stock becomes overbought on a breakout, to me, that's a sign that there's momentum behind the trade, especially in light of the fact that the new high is producing a higher RSI reading than when we tested the highs back in July. We are above a rising 200-day moving average, and on a relative basis, we're starting to break the downtrend line. XLV relative to the SPY is starting to break the downtrend line and move higher. I think it makes sense to start drilling down on the healthcare sector, looking for some leading industry groups within that sector, and then looking for the leading stocks within those leading industry groups when those stocks become oversold, the bullish and very bullish stocks that become oversold, kind of following the process. I mean, here's the process from the top down, right? Market's breaking out. Healthcare is breaking out. Identify the leading industry groups, identify the leading stocks within those industry groups. There is the top-down process laid out very clearly for you here using healthcare as an example. How about small caps? Small caps break the consolidation. Now, we have not been bullish on small caps, right? We haven't been shy about it. They've been underperforming. If you've been overweight small caps throughout 2019, that has been a drag on your portfolio. Right? No two ways about it. You can see the consolidation here for the past 12 months, but look at this, right? Series of lower highs by the IWM, the iShares Russell 2000 ETF, now being broken to the upside with a strong move higher on Friday. You saw the outperformance relative to the broader market on Friday. That is coinciding with the fund remaining above a now rising 200-day moving average. Breakout above the rising trend line, 200-day moving average, our measure of long-term trend. Also coinciding with the RSI shifting towards bullish ranges. So a momentum confirmation to what we are seeing in price. Notice that on the last few trips lower for the fund, RSI has not become oversold, right? Downside momentum was waning. And now we're getting a topside breakout with a shift or a potential shift in the RSI to bullish ranges, all while IWM is testing this relative downtrend line when measured relative to the S&P 500, right? One of our biggest knocks on IWM has been this relative underperformance. Also, I think that if IWM can break to new highs above this 160 mark, that would lend a bullish breadth confirmation. Right? It would just be another sign that more stocks are joining the rally to the upside. Overall, that would be bullish for the market as we enter the now seasonally strong months of November, December, and January. Finally, the 10-year yield is finding support once again. 10-year has been building a base above the 1.5 support level. We now have further support at the rising 50-day moving average, which is at 1.67%, right? Traded down there back half of last week and then rallied on Friday. Resistance at the 2% mark, but look at this shift higher. Series of higher lows for the RSI, indicating that downside momentum is waning. To the extent that this chart continues to move higher, it's bullish for the financials. It's a headwind for your bond proxies in the equity market, your REITs and your utilities. Continue to watch that closely. I want to thank you all for spending time with me every morning. It's an honor to be here laying out my thoughts for you. I hope you have a great Monday. Head over to chaikinanalytics.com/today to sign up for that email. I look forward to being back here with you tomorrow.